of the bedrock to stand on. What's going to happen in, this week, tomorrow, next year, that's a bigger issue. And so maybe in terms of that for investable time frame, in terms of the stocks, because I don't trade gold or silver. That's my savings. I trade stocks to try to make money. I'm looking for hockey sticks. So that question isn't the eventual debasement question of the giant X chart. The question is, can anybody imagine the Fed tightening anytime soon? As you and I speak, I don't know when this will go live, but as we speak, ADP just reported another 35,000 private payroll jobs disappeared. But actually, I'm not bearish. I have been saying and writing for some time that the longer this correction and consolidation for gold over 4,000 goes, the more likely it is that the next big move is up. And I know you asked about silver, but silver, whether the GSR widens or contracts, it tracks gold. So I do see that as the primary driver. And so it's hard to be bullish on gold and not be bullish on silver with a 90+% correlation, right? And the concern was that, going up to 4,400 was a peak and that was the top for the cycle. I mean, it's close enough to $5,000, which was many predictions that some of those bulls had before, that you could say, 44 close enough. If it goes down, well, watch out below.
Right.
But that's not what's happening. It looks like 4,000 is the new 3,000 and, the next big move is going to be upwards. So clearly that benefits silver. Now the scary thing, so that's the more bullish argument. I'm saying I think the next big move is likely upwards, including silver.
Right.
But even your diehard silver bulls, the most uber bullish of all, who never get called Darth anything at the silver conventions, they'll tell you that silver lags gold at first and then more than catches up at the end. So if we're in the more than catches up at the end part, that implies the end is nigh. But, right. I don't want the end to be nigh. I still have, I as a fundamentalist rather than a technical analyst, I think the debasement trade has years to run. So these things jar in my head. We shouldn't be at the end phase of this market. And, the shoe shine boy and the lawnmower boy, they're not talking gold and silver yet. All these things that characterize a blow off top mania, we're not seeing those in the market yet. So
traditionally, silver trails gold early in a cycle and then dramatically outperforms toward the end. That pattern is emerging again, but it raises an uneasy contradiction. The classic markers of a mania, public frenzy, casual conversations, and speculative excess are noticeably missing. Even as silver approached the $60 mark, a level that would normally ignite retail enthusiasm, the broader public remained quiet. This disconnect suggests the current surge may not be the finale, but a prelude to much larger moves. Fundamental indicators, especially global currency debasement, point to an uptrend with potentially years left to run, challenging the idea that we're nearing a final blow-off phase.
Mr. Market doesn't care what I want, but my approach or way I look at things tells me that we shouldn't be near the top yet. So this silver screaming northwards, well, if it's due to physical shortages, which a lot of silver bulls would say, yeah, there's not enough silver. But it's not that there's not enough silver in the world. It's that there's not enough silver at current price levels to clear contracts in London and the COMEX and so on. That's a different thing from an actual non-appearance of the metal itself. So I'm trying to be careful here. I'm hoping that silver cools off a bit. We were within kissing distance of $60 an ounce this morning. And I'm long, by the way. I'm not a bear hoping it goes down. I'm not the big short on silver. I'm long and I'm making money. I'm happy. But the bigger picture, I don't want the blow off top to be happening yet. But again, Mr. Market doesn't carry on. Sorry, this has been a long answer, but let me leave you with a couple things on this thing. One is, if we are going into the blow off top, I don't get my wish, and that's what's next. It's still the next big move is upwards. Like if this is it, the proverbial the blow off top, as crazy as it may sound, if you could know that was true, the smart way to play it would actually be to pile in now, even at all-time highs, and to go to the go-to names, the biggest, most well-known producers out there. When the generalist investor says, gold, silver, they're up. What's a gold stock? What's a silver stock? What are they going to find when they Google? Doug Casey used to call those the go-to companies.
Mm-hmm.
So anybody who's absolutely sure or sure enough to want to bet a lot of money on it, you know, it pains me to say this, Ivan, but the way to play that is to go to those go-to companies, even if they're at all-time highs, because the next big move will be even higher.
Mm-hmm.
It's you know, I can't say that I'm doing that with my own money yet, but that's what I would do if I believe that. And I got to say, the longer this goes, the more likely I'm to do that. The next big bet I make in gold and silver, if we don't get a correction, if it keeps going, I'm probably likely to do that very thing I just said. And even knowing that I'm paying all-time highs, I don't think I've ever done that in my life before. But the history tells us that if that's it, we're going into the blow off top, that the next big move is going to be upwards. And if not, if my other scenario works out, more, you know, silver cools off, the current physical tightness in the market in London and so on cools off, and silver corrects as gold has been correcting, I actually think we'll make more money that way, Ivan.
Right.
And that volatility will give the Johnny-come-latelys time to buy at better prices. Mm-hmm. So when I say that's what I hope will happen, that doesn't mean I'm bearish on silver. It means that I want an opportunity to load up on more, and gold as well. And I want an opportunity for people new to the space who missed it before to buy at reasonable prices instead of all-time highs.
Silver's rapid rise has revived long-standing debates about shortages. The issue isn't the total amount of silver worldwide, but the availability of metal at current prices to satisfy major contract markets like London and COMEX. This tightness has accelerated buying pressure, creating the kind of fast vertical price action some fear could mark a premature peak. Even investors positioned long are cautious. No one wants the ultimate blow-off to arrive before the broader population participates. A more moderate correction would allow new buyers to enter and reinforce the bull market's foundation, rather than exhausting it prematurely.
There's always these rumors on the internet, and it seems like they're never true.
Right.
It turned out that JP Morgan was spoofing gold and silver, or gold particularly. That one was true. Out of all the rumors over the last decades, that one turned out to be true. But notice that you know, people forget they were spoofing it in both directions. So yes, they were caught red-handed manipulating the market. But they could spoof gold up as well as down. The goal of the spoofers was not to necessarily hammer gold down and manipulate gold lower.
They want to make money.
They wanted to make money cheating the market.
Right.
That's what they were caught doing. So, yeah, you know, who knows? Some of these things might be true. I'm not going to bet on that basis. I do think that the broader, I mean, it's kind of hilarious now that the so-called debasement trade has become a thing on Wall Street. You know, we in the hard assets world, we've been saying this since the 1970s.
Right.
and now Mr. Market's finally catching on. Now, that doesn't make it untrue. It does make me suspect a little bit that, you know, if the lightweights in the sector, you know, glom onto some explanation, that makes me think that's probably something else, at least at the moment. And it's, you know, it's interesting. If it is the debasement trade, you know, the central banks are buying gold with one or two minor exceptions. They're not buying silver. They're buying gold. Basel III covers gold, not silver. And for all the problems that, you know, gold has for divisibility, you know, sorry, but blockchain solves that. Like, that's not a problem anymore. Mm-hmm. Fractional ownership of gold, you don't need silver or copper pennies to make change for gold anymore.
If this truly is the onset of a climactic move, history suggests even investments made at all-time highs could outperform dramatically. In such scenarios, major producers, the well-known go-to names, typically attract the largest wave of capital from mainstream investors discovering the sector late. However, the most profitable scenario for disciplined investors might come from a cooling phase instead. A pullback would reset sentiment, ease physical tightness, and create opportunities to accumulate quality assets at more reasonable valuations. Whether the next step is acceleration or consolidation, the long-term thesis remains firmly bullish as structural forces push capital towards scarcity-driven assets.
Even the monetary debasement or the monetary argument for gold doesn't really explain silver going to 60. So I do think it's multivariate. But big picture, I do, that when people say, well, how high can gold go? My answer is to turn around and say, well, when are governments going to stop debasing currency? How low can the dollar go is really the question. The late, great Richard Russell used to say when people called him a gold bug, he'd say, I'm not a gold bug, you're a dollar bug. And
Right.
that's the way to look at it. It's not the gold price, it's the gold dollar exchange rate. Same for silver, right? So what you really need to know or think about long term is, are governments ever going to get sane and rational and live within their means? Are currencies going to stabilize? Are they ever going to stop the debasement trade? And you and I both know, you're shaking your head. We know what
Yeah.
the answer to that is. And I think the audience does too. And I think that gives us confidence over the long term. Like we're right. My favorite chart in all our space is a chart of gold versus the purchasing power of the dollar since 1971, when Tricky Dick Nixon completely severed the dollar from gold. And
Yeah.
it's a giant X. If
Yeah.
you're patient and disciplined, that's all you really need to know. Ivan, if you were late and you bought gold in 2011 at the very top, that's less than half of what gold is now, right? So you've not only been made whole, you doubled your money. And okay,
Right.
it took 10 years, well, 14 years, but you know, you doubled your money. All you had to do is believe in that big X over time, and you were right, and everybody else was wrong.
Right.
So, I think that's sort of the bedrock to stand on. What's going to happen in this week, tomorrow, next year, that's a bigger issue. And so maybe in terms of that for our investable time frame, in terms of the stocks, because I don't trade gold or silver. That's my savings. I
Hmm.
trade stocks to try to make money. I'm looking for hockey sticks. So
Hmm.
so that question isn't the eventual debasement question of the giant X chart. The question is, can anybody imagine the Fed tightening anytime soon? As you and I speak, I don't know when this will go live, but as we speak, ADP just reported another 35,000 private payroll jobs disappeared.
The modern debasement trade, once niche, has now entered mainstream finance. Governments continue expanding debt, central banks accumulate gold, and geopolitical tensions deepen uncertainty. Yet gold remains the only monetary metal recognized under Basel III, giving it a regulatory advantage that silver lacks. Despite this, silver's rise reflects broader global anxiety about purchasing power erosion. Since the dollar fully detached from gold in 1971, the long-term chart forms a striking inverse pattern, declining currency value against steadily rising gold. This enduring relationship reinforces a simple truth. Precious metals don't rise because they change, but because currencies weaken relentlessly over time.
So,
Wow.
that's their weekly number now, I think. So I just, never mind Trump's pressure on the Fed. The numbers there, the reasons for them to shift from being more worried about inflation to be more worried about labor, I think that dual mandate pushes them on the labor side. I think that supports our thesis. That's bullish for monetary metals. It's bullish for anything real. Anything governments can't print in that environment where the Fed is cutting. Um, that's I think that's a reason to be optimistic. Makes me a little nervous to say that with all-time highs or near all-time highs, but that's the way the market works. When investors, when not you or I, but when COMEX traders think the Fed's going to raise rate, oh, gold doesn't pay interest, so we're going to sell gold. If they think the Fed's going to cut rates, well, oh, gold doesn't pay interest, so that less competition will buy gold, right? But actually, sorry, let me go sideways one other direction. I think there's a very important, large, and not exactly new buyer, but there are whales in the gold space and they're buying. And I think that the between the debasement trade going mainstream and the geopolitical troubles in the world and the even if you love the Trump agenda, the extremeness of the change that Trump is trying to implement and the impact that has on shaking, the economy up. All of these things make people very nervous, and that's very bullish for safe haven assets. So what I'm saying is, I think there are very deep pockets, not just central banks buying. It's
Yeah.
that old rule thing about how, the global allocation to gold historically is 2%. Recently, it's been 0.5%. So it doesn't need to go crazy. If it just reverts to mean, goes from half to two, that's a 4 times multiplier on investment demand for gold.
Right.
Prove this, Ivan, but I think this is what's happening now. I think there are deep pockets saying, you know what, I'm not, going to build a gold-filled bunker in Idaho, but it wouldn't hurt to hedge my portfolio with a bit of gold.
Labor weakness and political pressure suggest the Federal Reserve may soon prioritize employment over inflation, increasing the likelihood of rate cuts. Such shifts historically boost monetary metals by reducing the appeal of interest-bearing assets. Beyond retail traders and central banks, new institutional whales are quietly adding gold as a strategic hedge amid global upheaval, volatile domestic policy shifts, and shrinking confidence in long-term stability. Even a small return to historical global portfolio allocations, rising from 0.5% back to 2%, could multiply gold demand several-fold. In this environment, metals aren't a speculative bet. They're becoming essential insurance.